Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Alexandra Canal. Let's get you up to speed on the market action on this Monday. We are taking a look at the Dow, looking at 11th straight day of gains now, up nearly 200 points right now with an hour left to go in the session. We've got the S&P 500 up 20 points and the Nasdaq up roughly 30. Energy and financials, the sectors leading the gains today in the session, with energy particularly pushing higher on the back of oil and gas futures hitting a 3-month high. And of course, Ali, we've got a very busy week this week. Investors watching the central bank on one hand, and then of course, earnings.
Yeah, earnings kicking into high gear this week with over 150 S&P 500 companies set to report. Investors will be keeping their eyes on big tech with results on tap from Microsoft, Alphabet, and Meta. And Akiko, it's been an interesting earnings season so far. There were a lot of headwinds entering this print, particularly around inflation, how that was going to play out on the consumer side, also the collapse of Silicon Valley Bank in the spring, how that would impact some of those bank earnings. And by and large, we got sentiment that was better than feared, but we're still below some of those historic averages. So I want to read some stats here for you. About 18% of companies in the S&P have reported. Out of those names, 75% have beat on earnings, but that's still below the 5-year average of 77%. And then similarly, on the revenue side, 61% of companies reporting revenue above estimates, but that's also below the 5-year and 10-year average. So we're seeing some lag there on the earnings side, and I wonder what that could mean for some of the tech.
Yeah, expectations so low coming into this earnings season, but we're talking about big tech particularly this week because we've got the big names, Microsoft, Alphabet, and Meta reporting. These are the names that have seen the big gains, at least in the first half of the year. Looking at where they are, they represent roughly, 40% of market cap in terms of the 170 companies that are reporting. But it comes at an interesting time because we have seen so many analysts, including those on our show, come on and say, we could be at an inflection point. So much of this has been a crowded trade within tech. If there is some disappointment, will we see that move start to unravel? And you could argue last week, we saw a hint of that with Netflix and Tesla disappointing. We saw the Nasdaq 100 seeing one of its worst days in months. So are we going to see a repeat of that? That's a big question. And of course, when you think about particularly Microsoft and as well as Meta, but Alphabet more particularly, these are the names that have seen big gains on the back of the AI excitement.
Right, and I think investors are going to want a bit more clarity on the implementation of AI moving forward before just a mention of AI could boost those share prices. Now I think you need a little bit more context moving forward. And another thing that could impact these earnings is what the Fed does, right? And how interest rates move forward. We're going to have a lot of information coming out this week from a variety of central banks, including the European Central Bank, which is expected to hike rates by 25 basis points, the Federal Reserve, same thing there. And I think it's more so about the outlook here rather than what we see this week. Are we going to see Jerome Powell be more hawkish and signal that more rate hikes will come later this year? Will he take a more dovish approach? That is what's going to move markets, not necessarily the rate hike, which has been priced in at this point.
Yeah, and if we mirror kind of the equity story with what's happening in central banks, these growth stocks we've been talking about, particularly sensitive to these rate hikes. We were just showing the 3 major central banks that will be making a decision on their policy this week. You could argue the Fed's kind of out ahead of the ECB. It's certainly going to be questions about, what kind of tone Christine Lagarde is going to take over at the ECB. Yes, there's another interest rate hike expected there. Is she going to signal another one at a time when we have seen inflation start to come down? And then, of course, there's the Bank of Japan, which is behind all of them. But we have seen, inflation go past that 2% mark for 15 straight months. So they still have negative interest rates, sort of interesting in this environment. We're still talking about that, but will they finally get to sort of that starting block that we have seen the Fed as well as the ECB go? So it'll be interesting to see how the market reacts in the context of all that.
Yeah, we're all in this together. It's not just the U.S.
Exactly. Global market we're looking at here. All eyes, as we said, on the Federal Reserve. The Fed's 2-day policy meeting will kick off on Tuesday with the central bank set to announce its monetary policy decision at 2 p.m. Eastern on Wednesday. Yahoo Finance senior reporter Jen Schomburger joining us from D.C. On top of all of this, Jen, what can we expect from this meeting?
Hey there, Akiko. After taking a breather in June, the Federal Reserve is all but assured to raise interest rates by another quarter percentage point this week, with Fed Chair Jay Powell likely to keep the door open for further interest rate hikes later this year. Fed fund futures pricing in a nearly 100% chance of the Fed raising rates by 25 basis points on Wednesday. A 25 basis point rate hike would mark the central bank's 11th rate hike in nearly a year and a half. It would take its benchmark interest rate, that Fed funds rate, to a range of 5.25% to 5.5%, a 22-year high. With no new interest rate projections or economic forecasts released this meeting, all eyes will be on Fed Chair Powell and the outlook for monetary policy. Powell is likely to talk tough on inflation and suggest another rate hike in September could be possible to avoid financial conditions loosening. EY chief economist Gregory Dacco says given the strong job market and an elevated inflation still, he would expect Powell to talk hawkish during that press conference, saying, quote, "The last thing policymakers want is for markets to start pricing the Fed's terminal rate and rapid rate cuts in 2024, which would lead to looser financial conditions and upside risks to demand and inflation." Now, last meeting, officials penciled in 2 more rate hikes for the second half of this year based on higher expectations for core inflation. The Fed now expects inflation to end the year closer to 4%, up from 3.6% previously forecast. That's nearly still double the Fed's inflation target. If they were to go in July next week or later this week as expected, that will mark the first of the 2 rate hikes that the Fed has laid out for the remainder of this year. The policy meeting kicks off tomorrow, Tuesday, with the interest rate decision coming down at 2 p.m. on Wednesday, followed by Fed Chair Powell's press conference at 2:30 p.m. Back to you.
That means a busy few days for you, Jen. Jen Schomburger there, bringing us a preview of the FOMC meeting. Thanks so much for that. Well, let's stay on the Fed. As Jed mentioned, the FOMC meeting this week, economists are expecting another rate hike of 25 basis points. Officials signaled 2 more hikes this year at last month's meeting. The question is how quickly the next hike will come, or will it? Here with a closer look, we've got Hugh Roberts, Quant Insight Head of Analytics. Hugh, how hawkish do you expect the Fed chair to be in this upcoming meeting?
You want to kind of try and find an outlier statement to be a little bit different from the consensus, but I can't disagree with anything that you guys said at the top of the program or that Jen's just given there. You have to think the most important thing for Chair Powell will be to keep the options of rate hikes alive. So he will be determined not to give any kind of green light to markets to allow them to run away with an easing of financial conditions. So he might not be uber hawkish, but I think it'll be very much about optionality, keeping the Fed data dependent, and not trying really hard not to pay any lip service to peak rates and a reversal of any kind of dovish pivot.
Hugh, do you think the Fed can pull off a soft landing if, in fact, they do continue to raise interest rates through the end of the year?
Yeah, the million-dollar question that everyone's obviously so struggling with at the moment. History would suggest no. It's a tough act to pull that off during normal economic times. And I think what we've really learned this year is that the long and variable lags that we're all used to talking about when it comes to conventional monetary policy have been distorted even more by COVID and lockdowns. Now, even if you're one of those Wall Street strategists who's recently capitulated and moved their kind of year-end S&P 500 forecast higher, they're still on the whole looking for the market to come back down again. So the consensus is that these lags are still out there. They've just been distorted by COVID, and therefore I think one of the cliches out there is that the hard landing looks like a soft landing for the first couple of months until reality bites. And I think that's probably still the playbook for most investors.
In many ways, Hugh, the Jackson Hole Symposium next month gives the Fed, Jerome Powell and company, some breathing room to think beyond this current meeting and whether that second rate hike should come. What do you think the Fed should do beyond the July meeting based on the data that's come in so far?
So I think in a way, actually, it's less about rate hikes. Another 25 after this week, is that really going to make a big difference given the speed and the magnitude of the moves we've seen already? I think what markets will probably have more of an eye on is stuff like QE, the Treasury General Account, the spike in issuance that's coming for treasuries, and all that means for liquidity in the aggregate, as opposed to just focusing on Fed funds exclusively. It's a tough kind of needle to thread for the Fed. But I think, again, at Jackson Hole, you're absolutely right. Markets will be preoccupied with that over August. And I think, again, they will be trying to stress the fact that they want to try and enact a policy of normalization, try and shrink the balance sheet. They want to engage in QT rather than QE. They want to replenish the Treasury General Account. But they don't want to see another repeat of what we saw a few years ago in terms of the repo market jamming up and all the issues that caused the Treasury bond market and the spillovers into equities. So I think it will be kind of, again, options open, trying to normalize policy as much via balance sheet measures as it is via the Fed funds.
And one of the reasons we've seen consistent rate hikes is because Jerome Powell, he's been very adamant about reaching the Federal Reserve's inflation target of 2%. We've been talking to previous guests about whether or not that inflation target should be adjusted. Do you think it should? And what level should that be at?
Yeah, I mean, personally, I think it should be. There's no magic around 2%. But sadly, the timing is all wrong. This is definitely one of those narratives that you need to do it when you're coming from a position of strength. So, it's easy being a bit of a Monday morning quarterback, so I apologize, but, this should have been done sometime during the 2010, 2020 period. Not doing it when you're coming back down. And, you've had the low-hanging fruit of base effects for the first 6 months of this year. Improvements in headline CPI are going to be increasingly hard work going forward. Core CPI should still edge lower over the next few months. But to start tinkering with the inflation target when you're traveling from north to south, I would argue the optics is not good, especially when you look at the fiscal situation and the amount of bonds they've got to sell. So I know that's not the Treasury, that's not the Fed's concern, that's a Treasury concern, but you got to look at it holistically. So I think that we're not going to get anything on that anytime soon in terms of a target change.
Yeah, probably not good timing in the middle of a tightening cycle there. Let's talk about earnings season. We've got it kicking into high gear this week as traders eagerly await to hear from Microsoft, Alphabet, and Meta after big tech stocks have driven much of the market's 2023 gains so far. Hugh, what's your expectation here? I mean, you could argue they have had such an incredible run up. It's hard to meet the expectations going into this earnings season, but could we start to see that tech trade unravel in a big way?
Yeah, so we've seen a little bit of unraveling already. Can it go further? Yeah, I mean, I guess it could. But the one thing I would say is Quant Insight, we're a macro shop. We have a kind of an AI-driven process that takes a load of macro variables and then looks at tech stocks, the Nasdaq, S&P, dollar crosses, etc. So there are far better people qualified than I to talk about individual stocks and the company fundamentals and earning projections. But I think you're absolutely right with one of your comments earlier that Tesla and Netflix and the price action around their results last week did feel a little bit like a canary in the coal mine, a warning that that they're not going to trade well with bad news, but given how lofty valuations are. The only thing I would say to counter that is that from our macro perspective, one, our models have got incredibly high confidence at the moment. The macro factors are doing a very good job of explaining all tech stocks. Nasdaq, XLK, XLC, Meta, Microsoft, all really, really high model confidence on Quant Insight. And actually, the correction we've seen already has done a lot of traveling on our metrics. They're almost back to fair value. So from our perspective, which, as I say, is a uniquely macro perspective, and this week's going to be all about bottom up and company news, I get that. But from a macro perspective, a fair amount of the unwind has happened already.
Hugh, what about growth versus value? We've seen growth stocks heavily outperform some of those value names. Do you anticipate any bounce back in value towards the back half of the year?
Yeah, so from a personal perspective, I think that makes complete sense. All the conversations you guys would have had about, the lack of breadth to the rally, and we need to see catch up. And if the market does start to get excited about the story that we can get a soft landing, then yeah, cyclicals make sense. And we've seen price action in the Dow and financials over the last couple of sessions, beginning of this week, end of last week, perform well. Yes, but again, coming back to our models, we look at everything from a macro perspective. And actually, while you've seen Nasdaq and tech come back towards model value, something like XLI is now starting to get a little bit rich versus the prevailing macro conditions. So it really hasn't taken much for cyclicals to start looking a little bit stretched on the upside and tech to get back to fair value. And that just reflects the fact that credit spreads are still tight, rate vol is still behaving itself, and economic growth is still motoring along quite nicely and being quite resilient. That's the macroeconomic reality, and they're the fundamentals our model's picking up on.
We've got the Dow currently looking to continue its winning streak while the S&P 500 enjoys gains of over 18%. That's so far this year. When you consider what's happening in the earnings picture, the macro landscape as well, what does your portfolio look like right now? To what extent are you shaking things up?
Yeah, so I think what you'd have to do is I don't think you can personally, I don't think you want to divest yourself completely of tech, even on these crazy lofty valuations. The reality is I think you have to think about these big AI plays as options really, rather than as a kind of traditional equities. You're really buying an option on the idea that this AI frenzy is a genuine game changer. And we are going to see, a jump start higher in terms of company profitability, earnings, and everything else around it. So if you think about it in that metric, then yeah, lighten up for sure, given the run that we've had over the last few months, given the event risk around earnings this week. But total divestment, I think, would be an imprudent way to go, personally.
Should be an interesting week to see how things shake down. Hugh Roberts, Quant Insight, Head of Analytics. Good to talk to you today.
Thank you.
Well, the Dow is on track for its 11th straight day of gains, and it's the top performer today. Jared Blickery is here with a closer look at the move. So, Jared, are we going to do it? Is it going to be 11th gains?
It was a nail biter on Friday. I think the Dow closed in the green by maybe 1 point. We're going to see what happens today, but yes, looking green on the left side of the board for the U.S. indices. And let's take a look over the last month what has happened with the Dow. And here you go. Here's that first day. Here's day number 11. The bottom line is 5% over the last 11 sessions. That is substantial, and the Dow has really picked up recently. Let me just show you a 3-year chart, and you can see it broke above this resistance here only a couple sessions ago. This was the move that we were just looking at. And we've seen a lot of other markets. Dow was not first. We saw it first in the FANG index. That's at record highs. But we've seen these other indices kind of catch up. Here is the S&P 500. This had its own breakout a few weeks, if not a month, 6 weeks ago. And today, I'm actually looking at the S&P 500 equal weighted. And that is the normal S&P 500 that we talk about is calculated by market cap. It's ranked by market cap. The biggest companies get their big share of the point total for the day. But when you equal weight it, this has been a bit of a laggard this year. For all the talk about concentration, this situation has actually started to normalize. That happened a couple months ago. You can see really started taking off on that on the first day of June there. That was right around that non-farm payroll. You can see it's almost at the February highs here. So I'm going to keep an eye on that throughout the day. And just wanted to talk about the Dow in general because we have a number of earnings tomorrow. Let's see if I can get to that. Just wanted to show you, the previous guest was talking about industrials maybe rolling over. Well, tomorrow could be kind of an impetus for that. We got 3M. They're going to be reporting earnings. We also have a GE. That's a huge stock, still very much a widely owned stock. You just take a look at what's happened year to date. Might be surprised that it is up 68%. So if you're looking for a catalyst either to the upside or the downside in the transports and also the industrials, all of those earnings are right around the corner, guys.
It's going to be a very busy week. Jared Blickery, thank you so much. And we're just getting started here on Yahoo Finance Live. Coming up, Hollywood actors and writers are still on the picket lines, the actor strike entering its second week, and no sign of a deal on the horizon. We'll talk to one guest who says the strikes could cause at least $4 billion in damage to the economy. Then Twitter gets a new look. Twitter owner Elon Musk is ditching the social media's iconic bird logo and replacing it with an X. We'll hear from one guest who's calling the rebrand a consummate act of desperation. And later, we're getting you ready for retirement. We got key insights on the best practices for maximizing your retirement portfolio. Don't go anywhere. That's all coming up next. Welcome back to Yahoo Finance. Let's do a check of the markets sponsored by Tasty Trade. You're seeing gains across the board there, led by the Dow, which is up about 186 points. If the Dow closes in the green today, it will be the 11th straight day of gains. Also taking a look at the VIX, that is actually moving higher today ahead of the Federal Reserve's interest rate decision on Wednesday. The expectation is that the Fed will be hiking rates once again by 25 basis points. Investors will really be focused on the outlook there from Fed Chair Jerome Powell when it comes to future rate hikes. And it was a box office blowout this past weekend for Barbenheimer, the debut of both Barbie and Oppenheimer, bringing millions of moviegoers to theaters. Both films generated a collective $235 million plus at the domestic box office, Barbie accounting for $155 million of that total, while Oppenheimer brought in $80.5 million, according to studio estimates. And Akiko, there was so much marketing going into this weekend, so much buzz. I don't think we should really be surprised.
I've never seen so much pink pink.
Yes.
In one weekend, everybody I came across, I felt like was wearing Barbie pink, and I assumed they were all going to the movie theater.
Yeah, and I want to bring up some photos that I took when I went and saw Barbie on Friday. This is a local theater in Jersey. They had this whole setup here. Of course, I had to wear some pink and rock the Barbie. This is the line. It took 15 minutes to get popcorn, concessions were flying off the shelves. I mean, the decorations here, I just have never seen so much go into a movie premiere like this. And it arrives at a critical time in Hollywood too, because we have this double strike going on in the background. We don't know how it will impact the industry moving forward, especially the longer it continues. But movies rely on new content, right? So the longer it goes, there's a risk there.
You know, this, I think, exceeded even, you know, sort of the highest expectations, right, in terms of Barbie and Oppenheimer. But to me, it also speaks to what people want from the theaters. And I know you've been reporting a lot on, you know, how big the return's going to be, when are we going to get back to pre-pandemic levels. People want a movie experience and they want original content. I mean, if you think about what has come out so far this year, these were the two originals. You've got Barbie, you've got Oppenheimer, two completely different types of movies, but it's not the same franchise, recycled in a different way, right, for lack of a better word. I did think it was interesting that Oppenheimer managed to rake in more than 80, though, 80 million, because it is, what, a 3-hour movie?
Three-hour
It's
movie.
a long movie, and we saw a lot of people go out and have the whole Barbenheimer experience.
And that was a risk that a lot of analysts have said in the past. The longer a movie is, you run into people maybe not wanting to go see it, but you bring up a good point about franchises, because we've seen that this year. Fast X, Mission Impossible 7, Indiana Jones with Harrison Ford. They underperformed in the market, and it seems like there is a bit of franchise fatigue. People want new IP. They want that original content. That's what's getting seats in butts at the movie theater, and I think studios are going to recalibrate their expectations after this weekend, and it'll be interesting to see what new movies we potentially
Did you see Oppenheimer as well? I know you went to go see Barbie, so you got both.
Yes,
both
I got both experiences. I tried to do the back-to-back, but I couldn't get tickets for Oppenheimer right after. But a lot of people did commit to that. I would think you would want to see Oppenheimer first and then Barbie as a palate
We had a
cleanser.
discussion about that this weekend.
But other people maybe saw the reverse. Who knows? But that was an interesting trend to see emerge from this weekend as well.
I'm curious to see how sustainable the numbers are. I imagine word of mouth gets around. People who didn't get into the theaters the first weekend are going to go next weekend. I mean, this could really get the buzz going, or at least the momentum going at the height of the summer blockbuster season. But as Ali mentioned, Hollywood actors and writers are back out on the picket lines today for the second week of a historic double strike. Our next guest says the work stoppage could result in a $4 billion hit to the economy, and it won't just be limited to Hollywood. Let's bring in Kevin Clouden. He's a chief global strategist at the Milken Institute. And Kevin, that $4 billion number you have put out has really been shared widely, because when you think about the impact here, we're not talking just about studios, not just the content space, but much broader than that. How do you break down that $4 billion?
Well, what you look at is you start with what happened back in the 2007-2008 strike. And when we looked at that, we did the analysis a number of years ago on it, we found that it was an impact in California. That number was really about what was going on when the industry was way more concentrated in California than it even is now. And we saw it impacting all sorts of things in daily life you don't think about. We looked at it and we talked to people, and it was affecting restaurants and catering companies. It was affecting trucking companies. It was affecting welders. It was affecting construction people. It was affecting dry cleaners. It was affecting all sorts of businesses in hospitality and otherwise. And what you realize is that in a strike like this, especially as it's expanded, as it's not just the writers this time, with the actors, it's a total stoppage on almost everything that's scripted, that it's not just impacting these industries in California, but it's really doing so in New York. It's doing it in Atlanta. It's doing it in Albuquerque. It's doing it in Pittsburgh. It's doing it in all sorts of places where filming actually takes place. And we think of Hollywood as this great center, but it's because of film incentives and because of the way that the industry works, a huge amount of that filming is scattered all over that country. And that means that the economic impacts aren't just in California, but they're elsewhere.
And Kevin, it's worth noting that that $4 billion number, that would be double the damage caused from the last strike, which happened in 2007 with the writers. And I'm curious to get your perspective, given how far apart the unions seem to be from the studios, how long could this go, and who do you think will be first to cave?
Well, I think ultimately both sides will have to cave. And the problem is you have to get to that point. Right now, it doesn't seem like either side is ready to. The studios think that they can outlast the writers and the actors because they'll undergo economic pressures. They'll have rent payments, mortgage payments, basic utilities, cost of life issues. And the actors and the writers think that the studios are going to run into issues with content. And it really depends for each of them who will be under the biggest amount of pressure. Netflix likes to say, hey, we've got enough that we can last into next year, but Netflix is just streaming and they do have other things they can bring in. The question is they bring in international content like they did during the pandemic, do they start bleeding out subscribers? They've been adding them recently, especially with some of the moves they've made. But what happens if they take a hit? What happens if the studios don't have enough for the networks? What if they don't have enough for their fall slots? And all of those are issues that are going to come in. And right now, nobody's really in a great position. Coming out of the damage from the pandemic, coming out of the issues that have been placed in this, and the uncertainty around revenue on streaming, everybody's in a precarious position. Nobody really wanted the strike, but at the same time, both sides see the current situation as not viable.
And Kevin, you have to wonder, the longer this goes on, whether there's going to be some kind of division between sort of what we like to think is more the tech-facing companies like an Apple or a Netflix, and then sort of the traditional studios like a Warner Media as well as Paramount. I want to get back to that number, the $4 billion number that you mentioned. If you think about SAG-AFTRA, you think about WGA, they've obviously got funds that are helping support some members. There's the below the line, what's described as below the line, I should say, the craft services, others who are all part of that team that goes into movies. What do you anticipate the impact there to be? If we're talking restaurants, for example, that are fundamentally supported by some of these shoots, I mean, what's going to happen there? How do you assess the economic impact on that front?
Well, unfortunately, you have to watch and wait. That's part of what we're looking at when we're estimating an impact, is that last time round, and this is a number of years ago before we had a whole bunch of inflation and other issues, but when we were estimating it, we had to look at things on, did it impact rentals of apartments? Did it impact business closures? How many people got laid off in hospitality? How many people got laid off in other secondary businesses? What kind of longer term impacts do you actually wind up seeing? And unfortunately, that data is lagging. So we're only guessing, a very educated guess, but we're still trying to sort that out. The longer this goes on, the more that a number of these businesses who were already hit by the pandemic and having to stay closed or only have to deal with customers coming and doing takeaway if you're a restaurant, or even if you're a dry cleaner where there's very limited activity or anything else, those kinds of pressures are already there. So a number of these businesses may be more cash poor than they might have been otherwise. And so we're watching and waiting to see, do they operate by basically reducing the number of employees? Do they operate by potentially shutting down number of days? Or are they not able to make rent? And let alone, you have a number of real estate companies who had gone in, who had bought studio spaces because the increase in the amount of filming. They've invested heavily in this industry, not just in California, but all over the country. How much do they get hit? How much do investors get hit? How much does all of these secondary groups get hit? And meanwhile, you have a whole bunch of content creators who are like, well, I can just go on YouTube or TikTok. I can film from my own personal camera, do something to see if they can find alternate ways. And for the below the line people in particular, there are a lot of people we found in the last strike where they left. And we found it took a year for the industry to recover, because a lot of people basically were like, I can't make ends meet. This is too much. They move, they go into different jobs, other things happen, let alone all the delays in filming.
And Kevin, speaking of businesses that were hard hit by the pandemic, I want to talk about the theater chains because Moody's was out with a new report last week saying that movie theaters will be hardest hit by the double strike the longer it goes on, considering their reliance on new content. Do you agree with that? And what do you think it could mean for the future of the box office?
Well, the future of the box office has already been hit. If you looked at it pre-pandemic, you were already seeing a declining number of people going to the movies, except as for events, for things that they were particularly motivated by, like Barbie and Oppenheimer. And what this means now is if you don't have those pulls to get people into the theaters, they're going to have to rely on coming up with various alternatives that try and draw people in, but nothing brings people in like a new release. And the movie theater chains already were hit very hard during the pandemic because they were shut down in a number of different parts of the country for extended periods. So for them, this could be even more of a make or break moment, especially if the content disappears for an extended stretch of a few months.
The Milken Institute's Kevin Clouden, good to get your insights. We'll continue to follow the strike to see where things go. Appreciate the insight today.
My pleasure.
Coming up, a rebrand that's raising some eyebrows. Twitter owner Elon Musk replacing the iconic blue bird with a new X logo. We're going to break down how the new look could impact users on the other side of the break. We'll be right back. It's official. Twitter has a new look. Elon Musk announcing he is rebranding the social media platform X and doing away with the iconic blue bird logo. Yahoo Finance's Brad Smith here to break down the 3 things you need to know about this change. And Brad, I have to say, I have a soft spot for that Twitter logo.
Soft,
right?
Yeah, I love
Carolina blue bird. We all like that.
Yeah.
Yeah. And so this changeover came as a surprise to many this morning. I, for one, was on my way in and I was refreshing the app after wind and talk of the user-generated submissions that came through from his followers last night and over the weekend, essentially prompting them to, hey, come up with that next logo for Twitter. And we all know that Twitter is now owned by X Holdings, which is the company that Elon Musk holds and really only has less than 100 other investors. Now, those investors largely unnamed for privacy reasons. But all of that aside, many of them looking at this change as a potential way forward for what the future of X could be. And Elon Musk has teased a lot about this as well, and what could be a family of products too coming forward here.
Yeah, and we've been talking a lot about the super app, the future of it. Linda Yaccarino, she tweeted.
Yeah.
Do you still say tweeted? Like,
I think we have to change.
Do we have to change that? That's
Even
become
Elon
a
Musk
verb.
will tell us at some point, this is what we're supposed to call it.
I'm going to go with the ever pleasant and just super blanket and bland posted.
Okay, she posted
Yes.
saying that X will include audio, video, messaging, and banking capabilities.
Yes.
So, do we trust the future with the super app?
Well, and also to add on to that question, right?
Sure.
We have heard about the super app before. Everybody wants to be the WeChat that is in China.
Exactly.
What is to say that Twitter can succeed where others like Meta haven't yet?
Yeah, whether inspired by Tencent, whether inspired by Alibaba, or even, a multinational conglomerate like Stark Industries, Elon Musk clearly has some type of interest in creating this reality where you've got financial services that you can come into this realm and access, where you've got perhaps even some of your car data, things that can make your other experiences in life that much more seamless by just loading up what the X app may look like. And then, of course, you layer on the social media component to that, too. Now, what this comes back to also for a time where Twitter, or X, is moving quickly towards, like many other social media companies, 2024, which we're still waiting to see what the social media policy going into what has been called vitriolic anticipated election, what that will look like. And for many of them, trying to make sure that they're continuing to monetize through that period and not sacrificing margins, you're going to have to retain advertisers and those end users. So what in the user experience changes, if anything, right now, seems like not too much. So for the advertisers, does this give them a platform where potentially, if you do have a successful combination of all of these different app experiences, are you able to monetize better or see a better return on investment for those campaigns that you're running because of the reach potentially that's being pulled in from all of these different realms of life where people would have had to go to separate experiences ultimately to access those as well.
At the end of the day, it is about monetization, right?
Yeah.
They have been bleeding money. That's been very clear, even though they're not a public company anymore. We don't have all the data, but it'd be interesting to see how many people still stick around because we've seen users migrate to other platforms. Brad Smith, as always, thanks so much.
While Elon Musk's plan to reimagine Twitter as X is raising some eyebrows, we took to the streets to find out what everyday consumers think of the change.
It's like the Max rebrand. Like, no one's calling it Max. Everybody's still calling it HBO. Like, no one's going to call this X. Yeah, we're all still calling it Twitter.
I feel like they should keep it as the Bluebird icon because it's so iconic, and that's what you relate to Twitter as, like, the little bird tweets. And I don't think an X has that same impact.
I feel like brand recognition is important. I'm not sure why you would change something after, has it been 15 years of Twitter? I don't know. It seems silly.
I definitely think that the tweet and the Bluebird are very iconic, so I'm sad to see it go. You can't say tweets anymore. Like, you shouldn't say tweets, and they'll have to shift to something else.
All right, joining us now is Marcus Collins, marketing professor at the University of Michigan's Ross School of Business and author of the book For the Culture. And Marcus, as we just heard from a lot of folks there on the street, we've seen this before. HBO Max rebranding to Max, Facebook rebranding to Meta. What do you make of Twitter turning into X?
I think it's a sign of desperation. There's not a lot happening to the product. There's not a lot to talk about other than things aren't going so well, be it the launch of Threads, the launch of Spill. They're losing users and activity on the platform. So change the channel. If you don't like what's being said, change the channel. And this seems to be an approach to that. I mean, I wouldn't even call it a rebrand because the branding hasn't really changed. I mean, what is a brand? A brand is an identifiable vessel of meaning, right? It's a signifier that conjures up thoughts and feelings in the hearts and minds of people. We haven't changed what we thought about Twitter. Like our perspective hasn't changed at all. You just put a new name on it. Like you said, Facebook to Meta. You remember it was JCPenney's was JCP? No, we still know what it is. Changing the name doesn't really change what we think and what it means in our minds.
Yeah, Marcus, we're still talking about tweets today. I mean, I realize it's day one of the new branding, but you have to wonder how much of that conversation actually changes. The other thing I'm wondering is, a few weeks ago, we were talking about the launch of Threads. And yes, it became the most downloaded app overnight, but the engagement has dropped there as well. What is the demand, you think, in the market right now for a text-based social media platform at a time when we have seen so many take to apps like TikTok?
Sure. I think the launch of Threads was something novel, was something new. You took all the network effects that came from Meta through Instagram and put it over to Threads. So you probably got a disproportionate group of people, a population of people to actually use the app that likely wouldn't be on a text-based app. So I wouldn't use those first couple of days of Threads as an indicator to what Threads is going to do. I think as it starts to revert towards the mean, regress towards the mean, we get a better sense of what the demand is for a text-based app. I mean, ultimately, people are going to go where people are. Right? People are going to go to the party where everyone is. Nothing draws a crowd like a crowd. And even though people may descend on a place and there'd be a lot of activity, it's natural for the novelty to wear off and you get sort of the core base users. So I would say you give Threads a little bit more time. But Twitter, we know what we got here. It's been a constant decline on the platform, especially once it's become the ownership of Elon Musk. I mean, this is the hobby of Elon Musk. Right. And as a result, we're seeing the byproducts of what that means. It's just rolling back all the stuff that made the thing unique, that made Twitter interesting, right? As a safe space for people of color to talk. Not so much anymore when Elon Musk took over. So those people, Black Twitter as we know it, the cultural engine of Twitter, left to go over to Spill. Right. We start to see, civil liberties being rolled back as well on Twitter through censorship. You go, is this the place that we want to be? And there's no changes to the product, no material changes to the product. And therefore, it doesn't change what it means in our minds. And as a result, we don't see much of a change with this name changing.
And Marcus, I want to pick up on that point because we did see a lot of advertisers pull back on their ad spending on Twitter. So it sounds like from your view, you think this rebrand, it's not going to help from an ad spending perspective because at the end of the day, it's still under Elon Musk's ownership.
You're not saying, you put lipstick on a pig. It's kind of what this is. In a lot of ways, the advertisers are going to go where the people are. And if people are leaving the platform, then the platform is no longer as compelling to the advertisers, right? Advertisers are meant to avert, to get people's attention. So they're going to go where the people are. And if people are leaving, the advertisers are going to leave also. And if it's not a safe space for the brands, that is these advertisers, to show up, then they go, this isn't the right environment for us to be. And we see advertisers leaving the platform for all the reasons that we know. Look, this isn't going to be the death of Twitter. I think that's probably a little too a little too far-fetched. However, Twitter is not going to be what it's been. It's losing that, right? And as a result, we're going to look at Twitter differently. They won't be competing against the TikToks, the Facebooks, the Metas, the Instagrams of the world. It'll be more like competing against Truth Social, unfortunately.
Feels like more fragmentation ahead. Marcus, this idea of a super app. We have seen it all play out over in China with Tencent's WeChat. It feels like Twitter X is hinting at that yet again. Is there a demand for that? I mean, are users asking for that? A space where not only you can post social media posts, post photos, post audio, but also bank, purchase other objects. I mean, is there a need for that or a demand for that, at least if we're talking just in the U.S. market?
Yeah, it's a compelling proposition, but I don't think that the temperament of the United States will welcome a company to have that much of an aggregation of our information, of our stuff in our day-to-day lives. I think there's too much cynicism in the disposition of the United States for us to trust one company to have all those things. I mean, this is what was really at play here when it comes to a super app. It's trust. And I love this construct for trust. It says that trust is the mechanism that absorbs uncertainty. And when we think about the big mega tech companies, the tech giants that exist here in the States, there isn't that much trust. There's not that much of a mechanism that absorbs the uncertainty. And therefore, people are going to have a lot of reticence about giving all their information, all their activity in one place. So while Super App may have its functional benefits, I don't think that America has the stomach for that, at least not at the moment.
Trust continues to be very important for consumers. Marcus Collins, professor at University of Michigan and author of For the Culture. Thanks so much.
Thank you.
Coming up, the big business of booze. Premium tequila sales are surging among U.S. shoppers this summer. We'll tell you why next. Today is National Tequila Day, and the spirit is absolutely having its moment. Tequila was ranked number 2 of the 5 fastest growing spirits by revenue in 2022. That's according to the Distilled Spirits Council of America. Tequila sales are even outpacing beer sales. In the last year, unit sales of tequila have grown over 4%, while beer sales have declined around 1.5%. For more on this, we turn to Jenna Fagnan, Terramana co-founder. Terramana is a premium spirit brand founded by none other than Dwayne "The Rock" Johnson. Jenna, thanks so much for joining us today.
Thanks for having me.
You brought your lovely
National Tequila Day.
Yes, happy National on a Monday, no less.
Why is it on a Monday? That doesn't seem right.
We got to change the game. But I want to pick up on the trends that we've been seeing in the alcohol space. Why do you think there's still so much momentum behind tequila, especially as we've seen an explosion of brands over the past few years, Terramana being one of them?
Yeah, it's remarkable to see. I think none of us would have expected it 10, even 5 years ago. There was growth, but in the last 3 years, the constant annual growth rate has been over 14%, while vodka has been relatively flat. So the IWSR, which is our data source for our industry, one of the leading ones, they're saying that this year, tequila for dollar sales will overtake vodka, which is quite remarkable. And a lot of it just goes to the consumers evolving, they're changing. They want something with more story, provenance, something with more flavor. And that's where it's been a lot of fun for us with Terramana, is we've got such great storytelling to talk about and to talk about the process and how it's made. So the consumer's really curious and they're quite smart about their spirits today. And so they're diving in and finding out and really latching on to tequila because it can be very versatile. as well as flavorful.
When you talk about the consumer, though, are you talking specifically a younger demographic? I mean, where are you seeing the most growth in terms of tequila itself?
Yeah, it's interesting. I would say in the previous generation, even my generation, you grew up with mixto tequila, which was these tequilas that you would drink, you'd feel terrible the next day. And the younger consumer realizes tequila can be good, and it can be nothing added to it, can be 100% agave and water and really natural. And they're realizing that they're falling in love with it, and they're really thinking that that's the spirit for them. And so they're exploring and finding out that, hey, I really want to go into something that says something about me and is tasting it and enjoying it, but it is all age groups.
Is that in the marketing, though, you think? Because the ingredients itself hasn't changed.
Well, mixto tequila was not 100% agave, so it was a different product that was sort of back decades ago, and now 100% agave has taken over from that. So, for example, Terramana, we only use small copper pot stills, we only use 100% brick oven roasted. And so it really, you taste it and you want to make sure that you know what you're putting into your body. And that's something that was important for our founder, Dwayne Johnson, because when you've got someone like him, he is all about transparency. He's all about doing it the right way. And so even on the back of our Terramana bottles, it's the first spirit that's got nutritional facts. So you can see what's in there and what your nutrition is.
So it sounds like you can really drink this as it is. You don't need a ton of mixers. But that being said, though, we have seen the ready-to-drink cocktail category continue to explode. Are there any plans to expand the brand and maybe include some canned cocktails down the line?
Well, right now, it's really about the purity of the tequila. With Terramana, it's really about the consumer has shifted. And so while still the margarita is the #1 cocktail in America, they do like to sip. And we're seeing all age groups sip it and love it. And more, instead of going into canned cocktails, it's more about the purity of, or the experience of going into aged tequilas. So for example, we've got Terramana Reposado that aged, and then Terramana Añejo, which we can't keep in stock, which is further aged in former bourbon barrels. So it's really about the flavor and that experience rather than, at least for Terramana and for Dwayne, a canned cocktail.
And real quickly, Dwayne Johnson, what value does he bring to this company, not just as the face of the brand, but also as a business partner?
Yeah, he is, it's funny with celebrities, everyone talks about celebrity spirits, and a lot of them are just looking for a quick buck and they're putting their name on something. And in this industry, you have to really work. And there's not a human being who works harder than Dwayne Johnson. And everyone always says, is he who we think he is? Because we see, this incredible, engaging, natural, authentic human being, and he is completely that. He's always pushing us to say, are we doing it the right way? Are we showing respect for the consumer? Are we showing respect for the workers, for the land? For him, that is crucial. And from a business partner perspective, there's nobody better.
Awesome. We'll get him in here next time with you. Jenna Fagnan, co-founder of Terramana, thank you so much for joining us today.
Thank you for having me. Appreciate it.
All right, coming up, we're about less than 5 minutes away from the closing bell on Wall Street. We're still seeing gains across the board. As a reminder there, if the Dow closes up in the green, it'll be the 11th straight day of gains. Don't go anywhere. The closing bell is coming up next.
And there you have it, the closing bell on Wall Street on this Monday, kicking off things on a positive note as we see green across the board to close out this Monday session. The Dow now notching its 11th straight day of gains, closing up more than 180 points. The S&P 500 up 18 and the Nasdaq up 26. Certainly investors gearing up for what is a very busy week. We've been talking a lot about a focus on tech earnings, the FOMC meeting kicking off tomorrow as well. But for today, at least, we saw the energy sector leading the gains today as we saw big gains in oil and gas futures. At least that providing a lift to that sector. And this, of course, Market Check brought to you by Tasty Trade. Well, AMC shares skyrocketing after the cinema operator was blocked by a Delaware judge from converting its APE preferred shares into common stock. AMC has filed a revised deal with the court, citing its urgent need to raise capital. And take a look at the shares there, up more than 30%. Ali, you could also argue, though, this coming on the back of a huge box office weekend with the phenomenon that is now Barbenheimer.
Exactly. And so sort of the perfect storm here for the share price. And look, part of the reason why we're seeing the stock so high today is that it's a win for those current stockholders, because if those APE shares were converted, that's going to dilute the current share count. But I do think we're going to see a lot more volatility to come with this company, especially after they did submit that revised stock conversion proposal. CEO Adam Aron basically saying that they want this to happen as soon as possible, since AMC desperately needs the cash. They have a lot of debt on their balance sheet that they need to pay down. And we've been talking a lot about the double strike in Hollywood and the risk that that poses for theaters moving forward, especially with the lack of new content in the pipeline, really beginning in 2024, which is right around the corner if you think about it. So AMC, I think, is one of those names that we talk about often on this show. We've seen a bit of a bumpy ride since the meme fiasco in 2021. And you'll have to also remember that fundamentally on the street, analysts are on it, right? It has an underperform rating from Wedbush, $2 price target.
That was before the double strike.
And that was before the double strike. So there's just a lot of headwinds at this company, despite the fact that we did see a blockbuster weekend.
Yeah, it feels like a bit of good news with a lot of bad news, at least when you look ahead to what's waiting for AMC. Yes, they had a huge weekend, which points to the fact that there is still a demand for theaters. People want that experience, but we're talking just one weekend, two huge movies that were marketed in a significant way. But the overhang is that actor strike. You pointed to that Moody's report earlier today, which is really, at the end of the day, the theaters are the ones at risk. And this happening at a time when AMC was already struggling. So yes, we saw a big pop in the stock today, but you have to wonder what is waiting, because that cloud feels like increasingly will stay over AMC for some time.
Yeah, and
not just AMC, but theaters in general.
Theaters in general, because even though this weekend was really positive at the box office, we have seen so far this year a lot of films underperform those market expectations, and a lot of big franchise films like Mission Impossible 7, Fast X, even Indiana Jones, they underperformed the market. A lot of the expectation was that it was going to be high heading into the summer. So it's something to watch in addition to the strike. So we'll be following that very closely. Moving on to shares of Spotify, sliding in the red today after the audio streaming service increased the price of its premium service by $1. This comes ahead of the company's second quarter earnings before the bell on Tuesday. Now, it's interesting to see the stock reaction here, because this had largely been expected. We got the report from the Wall Street Journal on Friday that the price hike announcement was coming. But I do think a lot of investors are worried when it comes to what this means for Spotify's subscriber numbers, because they've been incredibly strong. We've seen price hikes from competitors, most recently YouTube Music. So I do think this is something Spotify had to do, especially since it's looking to increase profitability. But the impact of that on the consumer, I think investors are going to want more clarity on that on the earnings call.
Yeah, this seems like a direct response to what we have heard increasingly from investors, which is profits over growth. It's not just about the subscriber numbers at all costs. It's about show me where those profits are coming from. And when you think about its most earnings report, they did post a loss, right? An operating loss of more than $170 million. The company saying that, look, the market landscape has continued to evolve since the launch in 2008, which is really code for things are starting to slow down. We need to increase the cost here to get to that profit.
And look, Spotify, they spent $1 billion on podcasts over the past 4 years. That hit gross margins, it hit operating income. And now, considering the shift in the perspective from the investor, are you making money as a company? They've started to pare back on that. They've realigned their podcast division. They've committed to heavy layoffs across the company. So they're doing things to improve that profitability, which is why analysts have been pretty bullish on the stock. Year to date, even on the year, it's up significantly. And if you think about where we were, even at the end of last year, they've done a lot to really shore up some of that investor confidence. But it's a critical earnings report tomorrow, especially as we head to the back half of 2023.
Yeah, I know you're going to be all over those numbers there. Let's talk about another company you like to talk about,
I
Allie.
love this.
Domino's Pizza chain reporting mixed results in its latest quarter. The pizza chain missed revenue estimates, but struck an upbeat tone about its recently announced Uber Eats collaboration. The company saying that entering the aggregator marketplace could add $1 billion in new sales. You could argue, Allie, they had to strike that upbeat note. Yes, many investors very excited about that, but because of the miss on revenue, sales coming in a little better than expected, but this only increases that importance of those recent announcements they had in terms of partnerships with Uber Eats as well as Postmates.
And they hinted that they're open to more partnerships like that to come, which led to that boost in share price. But despite my greatest efforts, I love the Domino's delivery app. I love that you can watch it go in the oven. You can watch it come out of the oven.
I have to try it.
I'm a fan.
I can't remember the last time I ordered Domino's.
I ordered it on Saturday, but that's besides the point. But it's interesting to see that the company reported delivery same-store sales declining for an 8th straight quarter. So it goes to your point, Akiko, about how they needed this Uber partnership to really drum up some of those delivery sales. And they did say that in Q3, delivery sales are going to continue to be weak, but that in the fourth quarter, on the heels of that Uber partnership, along with them rolling out their revamped loyalty program, that they should see some improvement there. I'm bullish on Domino's. I love their flatbread, their cheesy flatbread. I recommend that. So we'll see what happens to the stock. I mean, year to date, it is up more than 10%.
Allie alone cannot support Domino's.
Sadly, no.
Something we talk about a lot on the show. But I mean, you know, it's not just a Domino's story, right? I mean, when you think about even other competitors that have really had their own delivery service, at the end of the day, that reach, especially with Uber Eats, is so big. You've got to have that partnership in place. You've got to be on the platform in order to break in more revenue, make it a little stickier.
Absolutely. There's just so much competition. But it was good on the revenue side that they're seeing some of those cost pressures ease, particularly around cheese. So hopefully that's a story that we continue to see. Another story we're watching relates to Tesla. Shares rising in today's trade despite a downgrade on Wall Street. Yahoo Finance's Praz Subramanian is here with the details. Praz, what do you got for us?
It's the old downgrade and price hike. One of my favorite moves of the day or whatever with these analysts. But anyway, yes, exactly. There was downgrade to hold. Patrick Hummel at UBS saying that, you know what, shares are fairly priced here, right? Nice big move up. I mean, Q2 numbers, there was a kind of a hit there, concerns about margins, but they delivered on Q2 deliveries, and the bull case is possibly intact through 2024 as part of one of the reasoning. So he talks about how, yes, strong demand is reflected in the share price. Q2 results validate the pricing strategy. They expect strong execution in 2024. Upside risk is limited here, so you're not going to see much of a pop here, but you're not going to see much of a drop either. And also the bottom line, the risk reward looks balanced. So that's the case with the hold, but also the price hike to 270. Talking about how they have more visibility into long-term growth. That's why they're sort of upping the price hike to 270, but making it a hold.
Well, this also coming on the back of those results from last week, which saw a big pullback in the stock. Other results you're looking forward to. General Motors reporting on Tuesday.
Yeah.
It feels like the EV division, yet another focus here, but what are you going to be watching for?
So last quarter, they had a big sort of profit beat and also a big revenue beat, but they had to actually up their profit guidance, adjusted EBIT guidance, $11 billion, $13 billion range for 2023. So that was a big deal. Got the stock moving much higher at the end of the Q1 results. But also the EV game plan. They want to build about 1 million EVs by the end of 2025. People will be watching to see if they can actually do that. 3 big releases this year: the Silverado EV, the Blazer, and also the Equinox smaller, cheaper EV. So that's sort of part of the big bull case for them from the EV point of view. Can they kind of make this year their year? Because they're sort of behind Ford. They're sort of behind Tesla. So that's something that people will be watching tomorrow. But also just big picture. Top line revenue, $42.82 billion, a 20% jump from a year ago, and also adjusted EPS of $1.65 for tomorrow.
All right, Praz, I know you'll be watching that report very closely.
A lot of numbers, all in the head. Yeah.
Thank
You'll
you
be
so
back
much.
on tomorrow.
Yes, exactly. And speaking of earnings, it's continuing to roll on. We have Alphabet, Microsoft, and Meta, just some of the heady hitters set to report this week. We'll get analyst insights into what to expect from big tech this quarter on the other side of this break.
After a successful trading debut in June for Savers Value Village, the thrift store operator is now seeing a flood of optimism from Wall Street. Here to break it all down, we've got Yahoo Finance's Brooke De Palma. And Brooke, you could argue the timing has really been right at a time when consumers are really trying to save a lot of money.
That's right. Consumers are certainly looking for value in this thrift store chain going public. I mean, what better time? Wall Street, as you noted before, very bullish on shares of Savers Value Village. 7 analysts initiated coverage today, 4 with a buy. Those include Jefferies, Goldman Sachs, UBS, as well as Guggenheim. Now, 2 analysts initiated with an overweight rating. Those include JP Morgan and Piper Sandler, and 1 analyst with an outperform rating from Baird. Now, no holds or sells are on the street as of now, but some key takeaways from the street says that Savers has an attractive profile here. As Akika noted earlier, we're really in a time where consumers are looking for value, and the thrift industry has structurally attractive tailwinds accruing from acceptance of secondhand as consumers look for that value. Their average price point is roughly $5. That's according to Goldman Sachs. Now, in addition to that, we're seeing low-income shoppers always go to thrift hand, but in recent decades, those middle-income shoppers have also flocked to thrift hand stores. Now, another key takeaway from analysts when they initiated coverage was that unit growth potential. Right now, they have roughly, or rather more than 300 stores, but the company is targeting roughly 2,200 potential new stores in North America. That includes non-traditional formats. And so Goldman Sachs really saying here that that format will ultimately drive stronger store profitability and better brand awareness in certain markets as it looks to expand. And that third takeaway here is ultimately their supply quality and stable margin outlook. Now, a majority of its inventory is coming from donors, with over 90% of their supply locally sourced. And so UBS is saying that the company is making sustainable improvements to its margin profile, increasing those on-site donations, and those ultimately improve sales yield. And so lots of drivers, lots of key takeaways that analysts are really looking and honing in on. And as you can see, it's certainly helping boost share prices today.
So Brooke, what's driving consumers? Is it primarily the macro environment right now?
Yeah, well, certainly right now we're all on inflation watch, and we continue to be. And consumers looking for value, looking for deals. But really, unlike its competitors that are publicly traded, like ThreadUp, like a RealReal, or not publicly traded company Poshmark, Savers Value Village really honing in on that in-store only operation, saying that consumers are really looking for those deals. And following its IPO debut, CEO Mark Walsh shared with Yahoo Finance how that physical footprint keeps consumers coming back for more. Take a listen.
What we hear from our thrifters is they want an environment that's fun. They love the treasure hunt. I mean, we put out 33,000 new items per store per average week. And then you add to that, a turn of 15 times. So our average thrifter, when they come in, they see a fresh environment almost every time. So the treasure hunt experience really drives, I think, additional motivation and additional shopper stickiness.
And loyalty is also a key tactic for Savers Value Village. Right now, they have 3.8 million active loyalty users, and a majority of those users end up driving sales. And so lots of ways that are certainly keeping Wall Street on pulse with this company.
Yeah, this is a company that's been around for decades, right? It took so long for them to go public. But
an environment like this, perhaps?
Yeah, potentially. Brooke DePalma, thanks so much for that.
Well, earnings season for big tech is about to kick off. On Tuesday, we'll be hearing from Alphabet, Microsoft, and Snap after the close. And later in the week, we've got Meta and Intel on tap. Joining us now is Daniel Flax, Neuberger Berman Senior Research Analyst. Daniel, thanks so much for joining us. I want to kick us off with some of these overheated names. A lot of the big tech companies right now seem a bit overheated in this environment. You can just take a look at Meta shares. They're up nearly 150% year to date. How does that set us up heading into this week?
Good afternoon. Great to be with you as always. I think the setup in the very near term is the market is worried about slowing growth, the impacts of inflation, higher interest rates. But if we step back and look at each one of these companies, Meta is focused on transitioning their business to more short form video with Reels. We're continuing to watch that closely. Google, which we'll see tomorrow, I think what will come out of it is that search is durable. YouTube, I think, remains a valuable platform, and there's good opportunity with the Google Cloud platform. And then I'll round it out with Microsoft, where I think they've continued to execute well with Azure. They're well positioned for next generation workloads in key areas like AI. But of course, they too will have to navigate what is a difficult environment.
Daniel, let's start with Microsoft, because that has been one of those names that has really benefited on the back of this AI exuberance. I think the exuberance is still the right word here. What will it take for the market to push this stock even higher, just given the run-up that it's had already?
What's interesting with Microsoft is they've been investing along with Amazon and Google. These companies are investing tens of billions of dollars a year in research and development and capital expenditures. And so what I think the market will need to see is visibility on strong growth later this year and into 2024. This is being driven by the health and really the durability of key platforms like Azure. We saw with the pricing announcement last week on Copilot that they're investing a lot in key areas like generative artificial intelligence. And then on the other side, if they can deliver value to users, then users will pay, which can ultimately contribute to strong revenue growth and free cash flow generation for Microsoft in the year ahead.
And Daniel, last quarter, it felt like just the mention of AI would send a lot of these share prices higher. What more do you think investors need to hear from these companies this quarter in regards to AI and the implementation of AI within these businesses?
When we speak to customers, there's a lot of anticipation and excitement about the potential of artificial intelligence as one example. Really, it's this larger build out of the digital infrastructure. What we're going to need to see from the companies is consistent execution on their product roadmaps, new product announcements, new offerings, really their ability to scale these offerings across their customer base. over the coming quarters and really years ahead. So it's relatively early, but what I think the market is going to look for is signs that these cloud giants, in the case of Microsoft or Amazon or Google, they can innovate, they can invest, and really create opportunities for their end customers to grow, which of course helps those platforms themselves.
Let's talk about what we're seeing later this week. Meta is one, Snap another one. Certainly a good pulse on what the digital ad market is going to look like. It feels like the expectation has gotten so low, given the slowdown we've seen on that front. Could we potentially see an upside surprise from a name like Snap?
Well, with Snap, and we continue to follow the name closely, they have a lot of, or they've delivered a lot of innovation to users. What we're looking for is more consistent execution from the company. I think in terms of the user population, the teens, 20s, and 30s, they've done a good job. I think they need to continue to evolve the platform. They need to remain relevant to users. And so we'll look to see the health of their user base and their ability to innovate. In the very near term, the environment remains difficult, but again, I think that's widely appreciated. The question is, what can they do on a go-forward basis, which is what we're watching.
Daniel, as you look ahead to the back half of 2023 and look at the environment that we're in right now, what do you think are the biggest risks to some of these tech names?
There's clearly macro risk. There's cyclical headwinds. There's trade tension. There's geopolitical tension. There's a lot of cross currents that are out there that we are, of course, watching closely, and we're seeing how these companies navigate them. I think what's going to matter most to some of the companies that we're talking about, be it Microsoft or Google or Facebook, or excuse me, Meta, is will they be able to execute on their product cycles through what is a challenging environment? If they're able to do that and the market sees increased visibility on better growth in 24 and beyond, then I think that can set the stage for outperformance. But it is a challenging environment, but innovation and growth are where we remain focused.
Finally, Daniel, given how frothy some of these names have gotten, any particular stock that you think could provide good opportunity as we go into this, the thick of the tech earnings period?
We like Google or Alphabet a lot at current levels. I certainly appreciate the macro concerns. There's a lot of questions around their competitiveness with ChatGPT and Bing. But what we're seeing is that they are bringing out new offerings like Bard in the area of generative artificial intelligence. And their relevancy with users and with advertisers, I think, is going to only increase as we go through this period and come out the other side. I think the YouTube platform will see better growth later this year and into next year, partly as the compares on that business ease. And I also think the Google Cloud platform is very much underappreciated. So you take these three pillars and look at the cash generation that I think we'll see out of the company over the next 1 to 2 years. And I think that makes for a very interesting setup at current levels.
We'll see if these companies can deliver. Daniel Flax from Neuberger Berman, thanks so much.
Let's do a check of the market sponsored by Tasty Trade. The Dow closing up in positive territory for an 11th straight day of gains, up 180. The S&P 500 up 18 and the Nasdaq up 26. And as we said, tech earnings certainly in focus. That sector up just slightly, about 1/4 percentage point today in the session. That brought to you by Tasty Trade. Well, coming up, it's time to start thinking about retirement as part of our week-long retirement coverage. We're going to tell you the best practices for maximizing your retirement portfolio. That's coming up on the other side of the break. 1 in 5 Americans believe they won't be able to retire. 70% of those cite financial concerns as the biggest reason. That's according to an Axios Ipsos poll. We're going to help you get retirement ready by breaking down what you need to know about the different types of retirement accounts that are available. Lucky for us, we've got Yahoo Finance's Carrie Hannon in studio with all the details. There's a lot of questions around this right now, especially given how choppy the markets have been. How do you think people should be thinking about retirement, and where do you start?
Yeah, I mean, my favorite thing is to tell people, don't think that you're saving for retirement. You're saving for your life, right? So this is a better way to reframe it. If you're lucky enough to have an employer-sponsored plan, like a 401k, and 50% of Americans do not. But if you have this, you have 2 great choices. The first one is generally, let's talk about the 401k. A traditional one is you don't pay taxes when they go into these accounts, right? It's pre-tax. And so you get the deduction today. But when you do take the money out, you are taxed on that. And you have to take the money out by age 72. And 59 and a half, if you go before that, you're going to get a 10% penalty and pay tax on the money. That's your number one typical plan. More recently, employers have been adding 401k plans, 401k Roth plans. So that's a difference from the traditional one. With the Roth, the beautiful thing here is, yeah, you pay tax before the money goes into this Roth 401k, but when the money comes out, you're not taxed on the earnings or the amount you take out. So this is that you've put in, that you've contributed. Now, there's typically a 5-year holding period, this sort of thing. But the important thing to remember here is if you think you're going to be in a higher tax bracket later in life, this is a great way to get started, and particularly for younger workers. This is a wonderful way if they don't need those tax deductions right now. The second thing is, okay, say you don't have an employer plan. Then you're self-employed, you're a contract worker. The thing to do here is you have a choice of IRAs, individual retirement accounts. So number one is the traditional one, where you put in money, again, pre-tax, and you'll be taxed as the money comes out. Now, the rules, it's not a lot of money. It's $6,500, maybe an extra $1,000 is bumped on if you're over 50. There's a SEP IRA. There's also a Roth IRA. Same idea as your Roth 401k, right? So you're going to pay the taxes first, then you put it in. Again, this is a play on what your tax rates might be afterwards. But the beauty of it is not paying tax when you pull that money out. And you have more flexibility. You don't have to take it out at age 72. Now, the other piece of this is a SEP IRA, which I love SEP IRAs if you're in business for yourself, because you can contribute up to 25% of your net income. And this is a really big help when you get started with retirement. So these are some of the basic plans. So I think people need to be encouraged to look at these as things to really help you have future financial security, even if you start small.
So Carrie, once you have these accounts set up, what types of investment decisions will you have to make once those are all set?
Yeah, so the first thing, Allie, you need to do is automate. So that before you even make any decisions, I want you to think in your head you're going to, have the reason you sign up for that 401k with your employer or you start your own IRA is automatically have that money taken out of your paycheck right away, so you don't even think about it. Also, put in auto escalation so that each year it's going to bump up 1%. Decide how much you want to contribute. I suggest that people contribute as much as their employer is willing to contribute, because they contribute based on what you contribute. Most employers who offer this match is 4 to 6%. So at least save that amount. Most experts tell you, if you can save 15% for retirement every year, the combination of your employer's contribution and yours, beautiful. Most people can do that. But start small. And if you do that auto escalation, it bumps up each year. So those are just some immediate sort of nuts and bolts. What I'd like to say then people say they look at that list of what do I invest in, especially with your 401k, right? It's a bit daunting. So what you need to do is say, okay, let's keep it simple. And what's become super hot recently is having a target fund. And most employers are offering these in the suite of different mutual funds you can invest in. With a target fund, it's invested based on when you want to retire. So it starts with sort of heavy in stocks, just glides on down as you get closer to retirement to more less risky cash, fixed investments, bonds, that kind of thing. So you get that nice swing down, and you don't have to make a lot of important decisions all by yourself if you're not a stock jockey, so to speak. The next thing here that I'm a big fan of target funds, as I said, but I'm a big fan of index funds. So sometimes for many people, all you need is a total stock fund. a total U.S. stock fund, a total international stock fund, a total bond fund, and I like the S&P 500 index fund, but this is simple. It's their baskets of stocks. It's balanced. No, you're not necessarily going to be hitting out of the ballpark with these things, but it's really a nice, balanced way to invest.
Steady gains, put your money there and don't look at it,
Yes.
right? During
That's the key.
choppy environment. When you think about the costs that add up during retirement, medical costs, it's a big one. And a lot of these aren't necessarily covered by Medicare. So how do you think Americans should be thinking about that in terms of the savings, the money you need to set aside there?
I'm so glad you asked that, because most people forget that, you know, medical costs are going to be one of the biggest chunks of what they're going to spend their money on in retirement. So there's this lovely little secret that no one seems to focus on, these HSA plans, health savings accounts. A lot of employers offer them as well through their benefits department. But you need a high deductible health insurance plan. You can do it on your own if you're a contractor or self-employed. What happens with an HSA, if you open one of these accounts, it's the trifecta. You don't pay tax for the money going in, you don't pay tax on earnings, and you don't pay taxes when it comes out. And you have to take it out for certain, you know, it have to be approved medical expenses. This is very not a hard bar to get to. And you don't have to take it out at 72 and a half. You can just keep letting it ride. And so with longevity, if people live into 90s and 100, this is a really smart investment for retirement that people often don't think it's a retirement account, but it's not like your flex savings account that you have. This is different. So, you know, I encourage people to talk to their financial advisors about, you know, should I have an HSA?
Yeah, bottom line, plan ahead.
Yes.
Right? I mean, that way you've got, when you still got the time, plan ahead. Carrie Hannon, thanks so much for joining us.
Thank you.
See you throughout the week. Retirement might seem light years away for some, but when it comes to getting started with retirement planning, financial advisors say it's never too soon. This week, Yahoo Finance is shedding light on the importance of retirement savings. Earlier today, our very own Jared Blickery spoke to Carrie Carbonaro, Advisors Capital Management Senior Vice President, and Mark Miller, author of Retirement Reboot, Common Sense Financial Strategies, on how Americans can best maximize their retirement portfolios. Take a listen.
Young people necessarily don't always think about their retirement because they always have other priorities that they put ahead of retirement. But I always say you can't borrow for retirement, so you have to start and you have to own your own financial future. So all the young people, I need them to get on budgets and then find the money in their budgets to contribute to their 401ks or IRAs or any type of workplace retirement plans, because if they start now, it is amazing how compounding interest will grow for them over time, and they are going to meet that retirement goal of $1.3 million, at least as it is today, if you've got 30, 40 years to save.
And Mark, similar question to you, and I'm noting as you're writing to us, at least half of us are on track for an unsuccessful retirement. How do we fix that?
Well, yeah, and that just defining that simply is the ability to maintain your standard of living in retirement. You know, with respect to younger generations, a couple of key concerns that I have are that, you know, fewer young people are going to receive traditional defined benefit pensions than previous generations, which are incredibly important sources of retirement security. And also, younger people are going to receive less in Social Security benefits when we look at that in terms of the amount of pre-retirement income that Social Security replaces will be lower for everybody born after 1960 because of the higher retirement ages put in place. So, you know, I agree that the good news is that, you know, time is on your side when you're young. I agree with Carrie's point there in terms of compounding, but I would just add this. I actually think, even though I write about retirement for a living, I think sometimes there are other things you should be doing first. You know, I don't think you should be carrying high cost debt, for example. You know, if there's an available dollars to use, I would use it to reduce high cost debt rather than going into a 401k. But that said, you know, so I think cleaning up your household budget is critical, and getting even small contributions. I often tell young people, put away what you can, even if it's a small amount, because it will compound and redound to your benefit over time.
Carrie, we've seen dynamics of the pandemic play out over the last few years. We've seen retirement kind of get redefined in a few different ways. We have the rise of the gig economy, so older people now have more options for doing part-time work. What are some of the trends you've noticed change with respect to retirement and retirement thinking over the last few years?
So there's a lot of retirement rewirement I've heard that term a lot.
I like that.
Where people are deciding what is retirement. Am I going to retire? Am I going to just slow down and get a part-time job? There's also the 3 different phases of retirement. I don't know if you've heard of them. The go-go, the slow-go, and the no-go. And so that actually affects how much you need to save, and that you're going to be spending a lot in the beginning, medium amount in the middle, and then, not as much in the end when you just can't move as much anymore. But what's also interesting with the new gig economy and everything is something that we never had before is the social media success porn, which a lot of people are looking at, young people and people pretending to be rich and having these amazing lifestyles. And it's all really not real. The TikTok and Instagrams of the world are showing all this, and people are actually believing it. And I always say there's no get rich quick, only get rich slow. So be careful where you get your advice from.
Yeah, so social media might be misleading. I can take that. I'll believe in that. Mark, I want to take it back to you. We've been talking about some of the younger generations here. What if you find yourself maybe in the middle stages of one's life and you haven't just saved enough? How do you catch up? What are some of the strategies that somebody who's a little bit older but hasn't saved enough can use to get on track?
Yeah, that's really the core focus of my book. And what I'm trying to explain in there is that even for people who are getting a late start, there are definitely steps you can take. So one of the most important ones, I think, is to understand the critical importance of the timing of retirement, which I think Carrie was just mentioning. Working even a few more years than you had planned can be an incredibly important lever, both because it allows you to delay your Social Security filing and hence claim higher benefits from the delayed retirement credit. It might allow you to do more catch-up saving late in the game. And net, it means fewer years that you're going to be financing through your savings because you're pushing out that retirement date. So I illustrate that through some hypotheticals, in the book. And I think, there are definitely things that people can do. I have a chapter in there on home equity. And, for most households, even those that haven't saved in retirement accounts, the majority of older households do own a home. And so, the home equity turns out to be the largest source of savings for lots of Americans. So it would be silly not to at least consider tapping that one way or the other, whether that's downsizing and moving or other means. So there's just some of the things that I explore in there. I think it's important to be really careful and thoughtful about your Social Security claim. And it's really important to understand healthcare, the cost of healthcare and retirement, and the importance of making smart decisions about Medicare.
And Carrie, your thoughts about the timing of retirement and how that fits into planning for it?
Sure. So it obviously it depends on what you're planning, when you're planning, where you're going to live, how much you're going to spend. There's so many factors, your longevity of your life. There's so many things that go into this. And I always say there's no one size fits all when it comes to financial planning. So I believe, getting with an expert, if it's really serious for you, to go in and make sure that you're maximizing everything that you're doing on your savings, make sure that you're making the right decisions, like Mark said, about Social Security. When are you going to take it? Do you have a pension? Obviously, most people do not at this point. So that makes a big difference of why retirement planning is so important today versus what it was 25 years ago when we had pensions and when the onus shifted from pensions to 401ks, which now the onus is on us. Also, I believe that it's really important, where are you going to live? Are you going to, yes, you're going to tap maybe your equity in your home, but are you going to downsize? And what states are you going to live in? Because obviously some states are more budget friendly when it comes to retirement. Mm-hmm. And that could really make a difference with, can you retire successfully or not? Could be even where you live.
Yeah, important.
The importance of, could I just
go
something
jump
there?
In. We got time for one more. You got the last word.
Thank you. Regarding getting advice and planning help, I think it's really critical for people getting closer to retirement. I think when you're young, the big goal is just save as much as you can, clean up your household budget. But things get more complicated as you get close to retirement and in retirement. So I include a chapter in the book about how to hire a planner. I think you want to look for a fiduciary planner who can help you, who's obligated to put your interests first. And that's planning help can be great, but you have to find the right type of help.
Get it in right immediately. Okay. Welcome back to Yahoo Finance. You were just watching a retirement video, but I am joined by Pras Subramanian and Josh Schaefer, and we're talking the top stories of the day. And guys, one story that we've consistently been talking about is this rebrand of Twitter to X. X marks the spot. I don't know what the tagline's gonna be, but this is an interesting story considering we've seen rebrands before. Facebook to Meta, if you wanna go on the streaming side, HBO Max to Max, but this seems random a little bit, considering how long Twitter has been around.
I don't know if you were just on camera when you did the motion of X, but do you think is that what they're going for? Is that part of the branding?
Elon did it. Elon did that.
Okay, so it's part of the branding. It's official part of the branding. I just don't get it. I mean, we were just talking a little bit before we started on air about the fact that when you bought Twitter, wasn't part of that purchase the intellectual property of Twitter, the different things that have been built up, right? People retweet things, people tweet things, people tweet thread things. Someone even wanted to take the word thread because it's become so popular, right? When you think about all these different parts of Twitter that people that use Twitter like, I get that Twitter hasn't been for everyone. It's not the most used social media. We've talked a lot about that when we talk about this purchase. But within the Twitter community and the different communities like finance Twitter that exists on Twitter, people like to call it Twitter. They like to tweet. They like the little bird. I don't really understand why you go away from the branding.
I love the little bird.
Exactly. So Walter Mossberg said that, like you mentioned Meta and things like that. Those are like changing, holding companies, not changing the actual product name. That's a big deal. It builds up a lot of
Facebook
brand
is still Facebook.
Yeah,
That's a great example.
Exactly.
Yeah.
We're talking about changing Twitter. And this, like we talk about tweets and retweets. Those terms didn't exist before. They came about as the product evolved. Twitter evolved. The bird, it's tweeting. I'm a little surprised that this is happening. Linda Yaccarino, the CEO, tweeted, "You don't have many chances to do a second impression or a second change." It's like, the reason why you don't do that, you don't change it because it's bad for business. I think it's a terrible idea to do this. I could be wrong, but I don't know what Musk is doing with this. Is it the kitchen sink trying to repair the business? I don't know.
The other thing I thought was interesting about this too is the timing, right? It's big tech earnings week. Twitter's not a public company anymore, maybe trying to get in the news this week. When you think about Meta's stocks up 150% this year, they're probably going to talk about the advertising environment getting a little bit better, right? They're going to talk about some exciting AI opportunities. They're going to talk about threads on Wednesday. This is Twitter's way of maybe getting in the news a little bit ahead of this week. I mean, it's official change, so it's a big step.
Yeah.
But I did find the timing very interesting when you think about Twitter not being a public company and not really having those moments to sort of flaunt out new products to us like Meta's going to be doing on Wednesday.
Yeah, and it does seem like Musk wants to maybe distance itself from Twitter a little bit because Linda Yaccarino, she did say that X will include audio, video, messaging, banking capabilities. So really leaning into the super app, which we've seen before. Whether or not that will take off for X, I don't know. That remains to be seen.
I just don't want to bank on this. I mean,
yeah, I'm all good.
It's not WeChat, you know what?
I said I'm all good on that.
Yeah, exactly.
I think using Twitter as a bank for me is a little much. But another story we have been following this year too, guys, has been what's happening with Adidas and those Yeezy shoes. Remember that they were originally not going to sell any of those Yeezy shoes. They've been trying to figure out what to do after the fallout of their partnership with Kanye West. Well, Adidas came out with a new update ahead of earnings next week, a financial update saying that they think they're going to lose less money off Yeezy shoes than initially expected. So they had previously expected an operating loss of $775 million, roughly. We're talking a conversion from euros here for the full year. They now think they're going to lose about $500 million. So that's $225 million less lost. That's after that first inventory unload of Yeezy shoes. Remember, we were talking about it a couple months ago. They really advertised it a lot on the website, perhaps more than people thought they were going to. Sort of not separating themselves from that Yeezy brand fully. And it seems like the demand, I think the big takeaway here is the demand from the consumer was still there to buy the shoes and buy the products.
Now, they're going to donate some of the proceeds to charity, but they didn't specify.
They did not specify how much that would be. And judging by the fact that they're now saying that they're not going to lose as much money as they thought, they're clearly taking some of the profits here.
I mean, it's absolutely kind of crazy. They ran out of certain sizes, certain colorways. Taking down that charge by almost half is crazy. I mean, I noticed, Josh, in the report that they still have gross margins of about 50%, but they're taking this losses because of the charges from Yeezy. And they're saying that we could have future releases that'll actually impact that charge again, bringing it down. I mean, in February when they took this massive hit, we had no idea that this might actually become a thing that maybe they actually take that's a wash on it. Maybe it's just a wash, and it's not a big deal. I can't believe, I spoke to a streetwear person, said people still wear Yeezy stuff all the time, and I'm surprised people are still buying it at this clip.
I think consumers have been able to separate Yeezys from Kanye West, or Ye, as he's referred to now.
Yeah.
I mean, you think it's hard, but I do think I would think it's hard, but I do think for sneakerheads, Yeezy has sort of taken on a brand of its own.
It's a brand of its own, right? And I think it gets into a generational conversation too about what people care about and how much they sort of look into that when they're buying things. And I think it's just an overall, as Pross was getting to, a streetwear conversation too. Nike's 10K came out last week. Over $6 billion in Jordan brand sales, up about $1 billion from a year before, up 30%. It was their biggest revenue growth driver of the last year. Like, just that shoe culture that we always talk about really is booming at a level that I think is hard to fully quantify, which is why you wonder too, Adidas is still selling these Yeezy shoes. They said they weren't going to remake them, but they're still selling. You kind of want that part of your athleisure brand right now. How do they sort of deal with that, right? And what comes next, I think, is an interesting question.
You have to think a second iteration is coming.
Just name them something different and have similar designs, right?
Well, I mean, who are Adidas' biggest like athletes endorsers, right? I mean, at this point, I can't really name any right now.
Well, there's a really popular guy that plays soccer in Miami now.
But besides soccer,
like build something around Lionel Messi, right?
Yeah, soccer, huge. But in this country, what NBA players?
Right, they don't have that kind of streetwear aspect that a lot of people haven't really been able to get that, right? Nike really hit it with Jordan, and then a lot of people have sort of wondered how to get there, and it's a good point.
Moving on from this strange story to an even stranger story, we saw in the Journal today writing about how young women and their families are paying consultants to get into sororities up to $4,000 in some cases to get into places top the detritus of the world in places like the University of Georgia, University of Alabama. I want to note that the documentary Bama Rush really brought this to the forefront, kind of giving us a peek behind the scenes as to how competitive it is. There's also some of the consultants who were featured in the documentary are also mentioned in this article. I can't believe how big business is and how hard it is for people to get into these sororities that they really want to get into. I want to note one thing: 125,000 women sought sorority spots across 500 campuses.
Wow.
20 to 25% did not get accepted. So, and these are big picture. Imagine how much higher it is for like the more prestigious sorority. So this is a wacky story to me. Unbelievable. $4,000.
Yeah, it's one of those stories that just makes you shake your head, right? When you think about how expensive college is, how expensive it is to participate in one of these sororities or Greek life on campus once you get into, I think it's over $1,000 or something like that, often per semester to participate in this. This just kind of makes no sense to me, to be honest. Like, it seems like we just need to find better things to spend our money on.
I got to get your view on this.
Yeah. Okay, so I was not in a sorority. My college did not offer sororities, but I'm not surprised that parents are paying this amount.
You have friends in them, right? I mean,
I do have friends in them, and it was pricey. It was a pricey endeavor, but I feel like to have a sorority coach, if you will, it's sort of like having a career coach or a life coach in a sense. And a lot of the things that these companies do are things people probably should do when they enter the job market. I mean, scrubbing through your social media, how to make a good first impression, how to dress to impress. I'm not totally anti the idea.
I think instead of spending $4,000 on someone to teach it, though, you could also like help your child with some of that stuff.
That's assuming, though, that you have parents that
dress professionally, scrub your social media. Like, if you have the means to spend $4,000 on something like this, you probably also have the means to maybe just get a little bit more involved and do that instead of siphoning it off.
Now we're getting into a parenting debate.
That would be my opinion.
I know you guys spoke about like the SAT prep versus that versus this, right? In that documentary, these people are talking about like, how do I talk to people? Like, they need like guidance on how to
Kids are on their phones all day.
Yeah.
They don't know how to talk on the phone. They don't know how to talk to people in person. We all grew up in a very different generation from these younger kids. And for some of these schools, Greek life is the only thing. And I mean, for young girls, it's a lot of pressure. Absolutely. So I do think as much as you can help your child, especially if there's someone that isn't comfortable talking in a crowded room or things like that.
That part of it definitely.
I do see the.
I just think there's also probably a trial by fire aspect of it too, right? Where it's like you learn how to talk to people by talking to people. and like putting yourself out in social situations and being in that. And I think that's one of the positives that something like Greek Life or other organizations on campus normally bring is like you go to the career fair, or you go to one of those things and you kind of have to figure out your way around, and you and your friends kind of awkwardly stumble in there, right? And that's part of how college and those first couple months work, is like you kind of get used to being uncomfortable, and I think you learn from that. And so I wonder how much we're just prepping for things that maybe you learn by practicing it and learn by being in that environment. And maybe there's something we're losing when we do one-on-one training for things that normally you sort of learn by doing.
All right, you learn to talk by talking, and we're going to keep talking about this story. Stay tuned to Yahoo Finance. It's closing time coming on the other side of this break.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. A strong start to the week for markets. The Dow Industrials extending its winning streak. The Dow closing higher for the 11th day in a row. That's the longest string of gains since February of 2017. The energy sector led the gains today, with Chevron a top gainer after posting a preview of its second quarter results, which beat estimates. The Nasdaq and the S&P 500 also rising on the day. Verizon's reportedly gearing up to raise prices. According to Bloomberg, the telecom giant will lift the rate on home wireless plans by $10 to $35 a month. The plan will reportedly be combined with a top-tier unlimited wireless plan and an auto-pay deal. This will be the second price increase in 2 years. Verizon is set to report earnings Tuesday ahead of the open, and investors will also be keeping an eye on fallout of the reports of lead-lined cables. And a big win at the box office for Barbenheimer. The debut of both Barbie and Oppenheimer, bringing millions of moviegoers to theaters. Both films generated more than $235 million collectively at the domestic box office. Barbie accounted for $155 million of the total, while Oppenheimer brought in $80.5 million, according to studio estimates.
Time now to look ahead at what to watch tomorrow, starting with none other than big tech earnings. Alphabet and Microsoft gear up to report their latest quarterly results after the close. This could be a significant test for mega cap names in particular, after a rally in the first half of 2023, partly driven by AI hype. Meanwhile, in the financial sector, PacWest is set to report earnings, giving investors a wider look into the state of regional banks. PacWest being among the names to be weighed down by the banking turmoil in May. Shares are down about 54% year to date. And moving on to some economic data crossing through tomorrow. The Conference Board will be out with a new read on the consumer in July. This coming after confidence jumped in June to its highest level since January 2022. Lastly, the housing market will be factoring in the latest measure for U.S. home prices. The Case-Shiller Index is out at 9 a.m. Eastern tomorrow, and we'll get a sense of how tight supply and high mortgage rates are weighing on prices. That'll do it for us here at Yahoo Finance Live. I'm Alexandra Canal, joined by Akiko Fujito. Be sure to come back tomorrow at 3 p.m. Eastern for all your coverage before and after the closing bell.